This is our Forex blog for Friday, July 5th, 2013. And one of the secrets to trading and one of the best tools in our software is actually using our currency index, which shows you at a quick glance what every currency is doing, whether it's going up or down, and key areas of support resistance it's likely to either stall at or reverse at. And then you use that to trade the strongest ones versus the weak and sell the weakest ones versus the strong. And also allows you to watch currencies at key areas such as the previous week's point of control. This is a major area because it's the price most traded last week in all the euro pairs. So it makes a wonderful profit target if you bought the breakout from underneath to above the hourly right here. And just like any regular chart, when you see a currency, for instance, find support at yesterday's low in the euro index, when it can't go lower than what the lowest point was yesterday and it breaks out above the hourly moving average, and you can also see it's in a very tight little range, that's a trend that's very likely to continue. You'd want to buy that versus, one of the weaker pairs, from 8:30 until this area right here where it's likely to pull back, which it did. After it pulls back a significant amount, you can look then to buy it. So here's some of the decent trades in the euro. When it broke out from below to above, a lot of times breakouts don't go the first time up. This one came down once, came down twice. The third wave up was the biggest one, so you could have bought this little pullback here and this one here as well, along with a deeper pullback after it moved a significant distance. So which ones would you trade it with? Well, from 8:30 to about 11:30, you can see that the Swiss was going up. You wouldn't want to trade the euro Swiss, but you can also see that the Australian is going down. And look at the exact same pattern happened on this. It broke the hourly, then it did a retest on the hourly, and so at 9:30 it's as high a probability trade as you're ever going to find. This one also, the euro also had pulled back, the Australian had pulled back up, hit the hourly resistance. Previous day's high is now resistance also. There's likely to be selling there, which it is, and you go short. So we short the Australian, long the euro. So the euro Australian is the pair. We're going to take a look at that at 8:30 right then, or maybe it was 9:30. Let's bring that back up and check. Yeah, it's at 9:30 right there. This is one of the higher probability trades you're going to find, and you also, by looking at this chart, can see that it was trending down, very nicely. It hit an extreme. The perfect oscillator, when it hits minus 80 or plus 80, it tends to reverse, which is what it did here. After that pullback at that 9:30 right there, you can see it went from around 4100 all the way up to 4175.80, and also hit our upper white containment band, which most of the time is where you're going to get the maximum. Typically at the 2.0 white band, markets reverse, and it did. You can also see that perfect oscillator was at the plus 80 level again. So extremely, probably 80-90% likely to reverse, and it did. So this is where you got in, and a lot of times you'll put your stop just underneath the swing low. So you bought there. This is how much you risked. And the key to trading is small losses, big wins. You never know what your profit's going to be, but even before you get in, the upper containment band is a pretty decent profit target. You could have also drawn a fib target on your first move and used that. But you can see, even if you got a fraction of this move, you made many multiples of what your risk was. And you always want to draw your fibs on the chart because they really give you a great feel for where the market's going to go to. And you can see it went right to that. We were very close to the 1.618. And like I said, the 2.0 white containment band tends to contain price. Most of the time when it gets underneath that level, you're going to get a reversal, reversal, reversal. Doesn't look at this one, almost to the pip a few days ago. Reversal, hits it, reversal, hits it, reversal. So if you ignore our better tools, and hang on to a long trade you bought here, hoping it's going to go up another 50 pips, you're going to be disappointed. You're much better off looking to get out when it stalls there. Perfect oscillator hits the plus 80, and then buy it again on a pullback. So that was one excellent example. Now we know the euro and the Swiss was going up, so you could have also sold the Australian Swiss, especially at 9:30, And you can see this one did the exact opposite. You know, broke down through the hourly. Unfortunately, it went kind of above it, so I'm a little less likely to get short right here like I did in the previous example. I would, in this instance, short the low of the previous swing here. You should also draw your fibs on here, and you got your fib targets down here. And guess what? It didn't go below the lower band, and also the minus 80 level was hit. It's likely to reverse because of the perfect oscillator and this. Two completely different tools. They both use statistics, and they both, you know, especially when coinciding, you know, you're near the 2.0 lower containment band, and perfect oscillators at an extreme. Great place to get out. And when you see a trend that's down like this, and you see a pullback where it's above the upper Bollinger Band on a perfect oscillator, and it's either at or very close to or above the 80 level, what a great place to short. This is also, you know, as close to a sure thing as you're going to get, and, you know, just kind of trail the stop down when it's kind of going sideways. And again, notice right near the minus 80 level, could have got out with a perfect trade right there. You know, these tools use statistics. They're not like any other oscillator you've ever seen for many reasons. One of them, it doesn't use a number of periods. It uses statistics. It doesn't have a 10-bar look-back period or a 20-bar look-back period. It has no look-back period whatsoever. And so therefore there's no lag in this perfect oscillator. There's no, you know, if you had a 10-bar look-back period in the MACD or RSI or many of these other ones, if 10 bars back there's a huge move. You know, when the next bar shows up, that 10th bar back disappears. With my perfect oscillator, that never happens. And so you don't have any huge moves of this that aren't caused by just, you know, price movement alone. Almost every oscillator is flawed for that reason. That's why I've always hated oscillators until I finally decided to come up with my own, because, you know, I've used a couple tools in more sophisticated, hard to interpret ways, you know, than this tool, and I tried over time to make it as simple as possible, and I think I did. So let's look for one more example. If you see a currency, you know, going sideways for many hours, let's say in a rectangle pattern, when it finally makes a big, you know, breakout of that area, it tends to, you know, cause a decent sized move, as you can see here in the Australian, in the euro here, in the dollar. So the dollar at 8.30 is also one that you could have bought versus the Australian as well. So let's take a look. That'll be the last example today. This is how you use our tools. Australian is likely to go down, dollar is likely to go up, and you can certainly see it here. Also note where the price kind of started to reverse at. You know, it kind of ran out of steam underneath the lower band. But before that happened, and you probably missed this first move down here, you might have sold the low of this area here, and it's much preferable to me is the pullback trade right here, where you know, have your stop right above here. This is your risk, and you're never going to catch every pip, but even if you catch a fraction of it, you're making more than your risk, and that's the key to trading. It's very simple. You know, if you got short right here around 9100 and it falls down here, it's kind of going sideways. Let's say you got out at 97, you made 30 pips. Your risk is less than 10 pips. And once it starts going your way, you move your stop to break even very quickly, because these trades either work or they don't. So, but a big majority of them go your way, a decent number of pips, 5 to 15 pips your way. So you move your stop to break even, and if the trade doesn't work, you know, might make 3 to 5 pips, break even. But rarely do you lose your entire initial risk, even though we're saying we're risking 10 to 15 pips on this. Most of the time, the actual loss is less than 7.